personal choice, entrepreneurship, small government. These are the core tenets of the Austrian School of Economics. It began in the late 19th century with Carl Menger, whose 1871 book Principles of Economics challenged the dominant classical theory of value. Classical economists such as Adam Smith and David Ricardo often explained value through the labor required to produce a good. Menger argued instead that value comes from the importance individuals attach to goods in relation to their needs. This shift towards subjective value became the foundation of Austrian economics. The Austrian school is not Austrian because it supports Austria's economic policies. The name refers to its origins in Vienna and the nationality of its early thinkers. Its major figures include Carl Menger, Eugen von Böhm-Bawerk, Friedrich von Wieser, Ludwig von Mises, Friedrich Hayek, Joseph Schumpeter, Israel Kirzner, and Murray Rothbard. These economists did not agree on every issue, but they shared a broad commitment to explaining economic life through the actions and knowledge of individuals rather than through large statistical aggregates alone. The first major idea of the Austrian school is methodological individualism. This means that economic events must ultimately be explained through individual decisions. Terms such as the market, the government, or society are useful shorthand, but they do not literally choose or act. Individuals act, and their actions create larger social patterns. For Austrian economists, inflation, unemployment, investment, production, and exchange must be understood by examining people's incentives, expectations, and choices. A second core idea is subjective value. A good does not possess economic value in itself. Its value depends on how strongly a person wants it and what alternatives are available. A bottle of water may be almost worthless beside a clean river, but extremely valuable in a desert. This does not mean value is random. It means value is rooted in human purposes. Because preferences differ, voluntary exchange can benefit both sides. A buyer purchases a good because they value it more than the money they give up, while the seller values the money more than the good being sold. Menger's theory of marginal utility sharpened this argument. People do not usually value entire categories of goods in the abstract. They value particular units according to the least important use that the available supply can satisfy. If someone has several bags of grain, the first may be used for survival, the second for feeding animals, and the third for producing alcohol. If one bag is lost, the person gives up the least urgent use, not the most urgent one. The value of each unit, therefore, depends on its marginal use. This insight helps solve the classical diamond-water paradox. Water is more important than diamonds, but an additional unit of water is often less valuable because water is more abundant. A third important idea is that prices communicate information. Market prices are not merely numbers attached to goods. They summarize dispersed knowledge about scarcity, demand, costs, expectations, and alternative uses. No single person knows everything needed to coordinate a modern economy. Consumers know their own preferences. Workers know their skills. Entrepreneurs form expectations about future demand. Producers know local conditions. Prices allow these separate pieces of knowledge to influence one another. Friedrich Hayek developed this argument in his work on the knowledge problem. He claimed that economic knowledge is scattered among millions of people and often exists in practical, local, or temporary forms. A central planning agency cannot fully collect or process this information. Even if planners are intelligent and well-intentioned, they lack the constantly changing knowledge embedded in market transactions. Prices adjust as conditions change, encouraging people to conserve scarce goods, search for substitutes, or expand production. This leads to the Austrian critique of socialism. Ludwig von Mises argued that a socialist economy without private ownership of capital goods cannot generate meaningful market prices for those goods. Without such prices, planners cannot rationally compare different production methods. They may know that steel, labor, and electricity are technically required, but they cannot determine whether one project uses resources more economically than another. For Mises, the problem was not simply that planners might be corrupt or inefficient. The deeper problem was economic calculation. A fourth major idea is entrepreneurship. Austrian economists view competition not as a static condition, but as a dynamic process. Entrepreneurs notice opportunities, make forecasts, combine resources, and bear uncertainty. They may discover that a product can be made more cheaply, that consumers want something new, or that resources are being wasted. Profit rewards correct judgments, while loss penalizes mistakes. This process continually reshapes production. Israel Kirzner emphasized entrepreneurial alertness. In his account, entrepreneurs move markets toward greater coordination by noticing price differences and unmet demand. Joseph Schumpeter, who was influenced by the Austrian tradition, focused more on innovation and creative destruction. New technologies and business models displace old ones. Economic development, therefore, involves disruption as well as improvement. The decline of an older industry may be painful, but it can reflect resources moving toward more productive uses. A fifth Austrian idea concerns capital and time. Böhm-Bawerk argued that production usually takes place in stages. Consumer goods are not produced instantly. They require tools, machinery, training, transportation, and intermediate goods. More roundabout, production methods can be more productive, but they also take longer and depend on prior saving. Interest in this view reflects the fact that people generally prefer present goods to future goods, all else being equal. This principle is called time preference. The Austrian theory of the business cycle builds on these ideas. Mises and Hayek argued that artificially low interest rates, often caused by credit expansion through the banking system, can mislead entrepreneurs. Low rates appear to signal that consumers have saved more and are willing to postpone consumption. Firms then invest in longer-term projects. If the apparent savings are not real, these investments may prove unsustainable. The boom contains malinvestment, meaning resources are committed to projects that cannot all be completed profitably. The eventual recession is the painful process through which these errors are revealed and corrected. This theory differs from Keynesian explanations, which emphasize insufficient aggregate demand, and from monetarist approaches, which focus heavily on the money supply and policy mistakes. Austrian economists tend to oppose attempts to preserve booms through further credit expansion because they believe such policies delay necessary adjustments. Critics respond that Austrian business cycle theory is difficult to test, underestimates financial instability, and offers too little support for emergency intervention during severe recessions. Austrian economics also has a distinctive method. Mises used the term praxeology for the logical study of human action. He argued that economics begins with the fact that people act purposefully, choosing means to achieve ends. From this starting point, economists can derive certain principles, such as the idea that voluntary exchange occurs because both parties expect to benefit. Austrians are often skeptical of excessive mathematical modeling because models may assume away uncertainty, creativity, and changing knowledge. This does not mean that all Austrian economists reject data or history. Hayek, for example, used historical and institutional analysis. The Austrian objection is usually directed at the belief that economics can operate exactly like physics. Human beings learn, adapt, change their expectations, and respond to theories about their own behavior. Economic relationships may therefore be less stable than relationships in the natural sciences. Politically, Austrian economists are usually associated with classical liberalism, limited government, private property, and free markets. Mises and Hayek defended liberal institutions because they believe decentralized markets coordinate knowledge better than centralized authorities. Rothbard developed a more radical version of Austrian economics and argued for anarcho-capitalism, in which even law and security would be privately provided. Not every Austrian accepted this conclusion. Hayek, for example, allowed for a larger role for government, including general legal rules and some forms of social protection. The Austrian school has several strengths. It offers a powerful account of how prices coordinate dispersed knowledge. It takes uncertainty, entrepreneurship, institutions, and time seriously. It also explains why well-intentioned interventions can produce unintended consequences. Price controls may create shortages, subsidies may distort investment, and regulations may protect established firms from competition. Its weaknesses are equally important. Critics argue that Austrian economists often rely too heavily on deduction and not enough on empirical testing. Some Austrian claims are stated so broadly that they are difficult to falsify. The school can also underestimate market failures, unequal bargaining power, environmental damage, and the role of public institutions in supporting markets. Its political conclusions do not always follow directly from its economic analysis. The Austrian school remains influential because it asks questions that standard models sometimes neglect. How do people act when knowledge is incomplete? How do markets coordinate plans that were never centrally designed? What role do entrepreneurs play in discovery? How do monetary institutions shape investment over time? Its central message is that an economy is not a machine controlled from above. It is an evolving order created by individuals who possess limited knowledge, pursue different goals, and adjust to one another through exchange, prices, profit, and loss.